Subscribe to Bisbo and press the bell icon. See boring news turn into enjoyable stories. The word decoupled is just a fancy word for separation. And no, it's not that Netflix series with Madhavan and Surveen Chawla. It's simply a word coined by economists to make them sound important. But to be fair, the word has suddenly become a buzzword among the Indian financial community because old laws seem to be breaking in order to accommodate newer problems the world is throwing up. The Ukraine war has spiked up the prices of oil and other commodities. Stubbornly high inflation in the US has forced Feds to increase interest rates. India's neighbors, Sri Lanka and Pakistan, are in deep political and economic crises. And the biggest one, India getting knocked out of the Asia Cup. Okay, that was a joke. But India too has had a rough year. Its rupee tumbled, reaching 80 to the dollar, and continues to face challenges there. FIIs pulled out over $33 billion from the Sensex peak of October 18, 2021, making it tank over 10,000 points in 8 months. Unicorn failures on listing further added to the gloom. Now while Europe slides towards recession and faces a long, cold, gasless winter, it feels almost like springtime in India. The Sensex is inching its way back to where it was earlier, adding 13 lakh crore extra market capitalization along the way, making its market cap the 5th largest in the world, overtaking France, Canada and the UK after they dropped between 14 and 27%. As foreign portfolio investors turned net buyers of Indian equities since July to the tune of almost 50,000 crore. By the end of August 22, India had moved up to second spot in the MSCI Morgan Stanley Capital International Emerging Market Index, tying with Taiwan. And even as the Emerging Market Index shed 6.5% in the 3 months until end August, MSCI India gained 6.14%, while China saw 23% $5 trillion rout, opening up a significant gap between Indian stocks and other emerging markets, as India outperformed its emerging market peers by 20% since the beginning of the year, the highest in a decade. India's PE, price earning multiple premium over emerging markets, widened to a record 100% as they fell marginally while India rose, accentuating the difference, prompting investors to conclude that India had decoupled itself from its peers, that is emerging markets and not US markets, as some may be led to believe. Because while numbers to numbers, India may have outperformed the US since October 2021, if the Indian index is converted into US dollars, then the difference narrows sharply, reiterating that this situation is at best a theory of India decoupling from emerging markets. In fact, this is a peak return for Indian stocks, and even then it barely beats the Dow, something it hasn't been able to do often because regular rupee depreciation makes it tough for the Sensex to outperform the US market, which makes a strong case for parking part of your portfolio in dollars. Something which you can do using the Vested app, which offers a wide choice of options for investing directly in the US market, particularly making the process of buying fractional shares directly from your phone very simple, allowing you to use your existing UPI account to buy US shares straight through the app in a seamless process. You can choose from their predetermined selection of vests depending on your investment outlook, or if you want, make your own vest. Go to DIY Vest and create your own basket of shares. You have the option to select all the big names because the US allows fractional ownership of shares. Then track your vest in real time and compare it to the S&P. Vested is offering a $10 gift to everyone who funds their Vested account. Don't miss out on this amazing offer. To know more, click on the link in the video description. Coming back, the Morgan Stanley Emerging Markets Index is widely tracked by global fund managers for fund allocation. If the weight of a country in the benchmark index increases, passive funds mandatorily need to match weights in the same quantum, while active funds allocate funds over and above what the weightage suggests. The way the cookies crumble, India seems to be in the sweetest spot compared with its emerging market peers, China, Russia and Taiwan. And even though China's weight in the EM index dropped by 9%, it still continues to enjoy the highest weightage. But severe restrictions in major cities due to COVID-related issues plunged its growth to a mere 0.4% in the last quarter. The regulatory crackdowns on big companies like Alibaba, Didi, Tencent, etc. are damaging confidence in their story. Added to which liquidity problems in their real estate sector ended up tumbling the yuan to a 2-year low past the psychological mark of 7 to the dollar. The weakening currency though will create problems for other export-reliant countries, even in faraway Africa and Latin America, who may be forced to resort to competitive devaluations of their currency in order to make their exports appealing. The other emerging market, Russia, initiated an unnecessary war and is stymied by crippling sanctions, while Taiwan is on the brink of a face-off with its powerful neighbor and will be forced to allocate huge spends to defense. That leaves India relatively unscathed with its inherent strength of a vast Indian domestic market consumption story on which FIIs are banking, where urban and rural consumption rose in the April to June 2022 quarter, the highest in the last 4 quarters. Foreign investors are ignoring export-oriented sectors since those remain vulnerable to currency volatility, geopolitical uncertainties, and the looming slowdown in developed countries. The Indian rupee though remains under threat, and despite the RBI selling a massive amount of dollars to defend it, they were unable to arrest the slide as the rupee breached 80 to the dollar. The rupee's expected inclusion in the JP Morgan Emerging Market Bond Index, to which global assets worth $842 billion are benchmarked and which could have brought in $30 billion worth of inflows into India's debt securities, was deferred as many smaller funds found the paperwork and red tape too cumbersome and not worth the effort. India has a historic opportunity, and despite some hiccup, it seems that the Prime Minister and Finance Minister are up to the task. Because sooner or later, China will start humming again, the Ukraine war will end, and oil prices will rise. But in the meantime, India can take full advantage of the situation and make a giant leap towards its $5 trillion by 2025 aim. Bisbo's limerick: decoupling's a separation without a fight. In emerging markets, India's finally showing her might. The opportunity is there, like a challenge or a dare. If we take it with both hands, our future's bright. You will also find these sources listed in our video description section.